Hello, welcome to the Economic View. I'm joined today by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hi, Tony. How are you?
Yeah, very good. Look, it's end of financial year coming up, and we're going to depart from the script slightly. We will talk economics, but really need to talk about markets, market returns over the financial year, and really just sort of to put that in perspective of where we are, where we started from, and what's likely to be ahead.
Yeah, and also what's worked, what hasn't worked. So let's sort of have a look at it. So, chart on screen. This is just the ASX as it is, and this is, you can see, for 4 of the last 5 years have been a positive year. So this year on a capital basis, currently there's a few days to go, but let's say we're close enough to it. It's 8.4%. Now, more importantly, total return basis for the ASX 200, we're sitting at 13.5%, and that means that 9 out of the past 10 financial years on a total return basis, we're up. So pretty positive thing from a portfolio perspective. You then want to sort of go slightly more granular and have a look at this financial year, who's added what, who hasn't, etc., as you alluded to. If you go really subsector, interesting ones are the autos and parts division. That's up 44%. Biotech is the next one at 43%. So they're quite up there. The other side of the coin, and I'll probably put it to you. Could you tell me who you think would be the worst performing subsector in the ASX 200?
Oh, you're putting me on the spot, Evan. No, I won't buy into it.
Well, yeah, fair call. But considering how telcos have been this year, it's well and truly the worst performer, down 29.5%. So we know about the issues around Telstra. We've seen issues with, across the board, TPG, blah, blah, blah. So they are a country mile, actually. So 29%. The next worst performer is the banks, which is also quite an interesting thing. In the 200, as a whole, the financial banking sector is down 10 and a bit percent. And Banking Royal Commission, credit squeeze.
Yeah, banks are under a lot of pressure, aren't they?
Housing market slowdown. So all that can probably culminate into why it's been there.
Yeah. When we look at the Aussie market versus offshore markets, and we were chatting about this off air, but if you take it back for the full year, for the full 12 months, Aussie market versus US market is streets ahead of the Aussie market.
And let's sort of point out, the US market, when we talk about it, there's 3 parts of it. So you're right, they are streaks ahead. NASDAQ is absolutely, not only is it killing the Aussie market, it's murdering everything else. It's 21% from July 1 last year to now. The S&P doing just as well. It has come back. The one that's a little bit disappointing is the Dow. Year to date, it's down, but over the financial year, it is up and up quite solidly. But
I was going to say there's a big but in the middle of that. The but is that since early this year, once this whole trade war stuff started to really raise its head and be implemented, the US market's just really come off.
And on that, the interesting thing around that is it's the old, what we call the old world, the old American economy that's really felt the pressure of the trade wars. So the Dow is made up of the 30 largest companies in the US by price, not by market cap, by price. And they're the ones that have felt it. They're your Fords of this world. They're also your IBMs of this world. They are things, Boeing is another example of companies that are old US, basically stalwarts of that world. They're the ones that have really dragged on the Dow off the back, as you alluded to, those trade wars. And they're the ones that you would certainly point to in 2019 that's going to have a lot of interesting political inputs, considering trade war, I believe, is only just beginning.
Yeah. I met with the head of State Street from the US last week. He says that the biggest challenge ahead is really all this protectionism that's coming into play on the economic level and the markets level, and there's a lot to play out there.
It's interesting that he highlights that from a US perspective, because the other thing that's really interesting that I also wanted to show, another chart on screen, is we are looking a little bit further ahead, but that's okay. I think we should do that. Is that it really talks about the China-US trade war. The chart on screen shows you very clearly that this is actually the protectionist policies that statewide we're alluding to that have either been implemented or are threatened against every country that he's putting it to. So it's not just China, it is the European Union, it is Canada, it is Mexico. Japan is in there on their auto industry. That's quite an astonishing thing. So total, it looks like if you put them all together, including threatened, it's $800 billion US. So FY19 certainly has political headwinds, and protectionism is a big precursor to possibly what could be an interesting risk-off year, because it just artificially moves price. It doesn't actually necessarily add to any form of corporate growth or actual economic growth, and it will be quite an interesting year from that front. And I think that chart perfectly illustrates that.
All right, let's wrap up here. There's a lot to talk about, but the other side of the overall equation is really the economy, the Australian economy. So let's focus on Australia. Interest rates, nothing really to talk about apart from
Sitting on the
rates not changing, and there's been a lot of conversation around why rates aren't changing. But GDP, things like wages growth, how does that sort of play out for investors?
Yeah, GDP is good. We won't find out for the full financial year until August, because the second quarter doesn't happen to them. But if you look at it now, 27th consecutive year of growth. GDP for 2018, we are sitting at 3.1%. Third best rating we've seen in the post-GFC world. So 2012, we peaked out at 3.6, and we did it again in 2016. So we're not far off it. You alluded to employment. If you take the financial year, not the full calendar year of 2017, but the financial year, we've added around about 360,000 jobs. So very, very impressive, but wages are still a fairly major headwind, and inflation's weak. So economically, things are still pretty good. As you alluded to, interest rates are not going to move. So all of that is still a fairly growth-laden economic viewpoint, and it's going to continue into the start of FY19. You will, however, want to start seeing some form of improvement in wages.
So we'll see how all that pans out in terms of markets and the economy really past this weekend, which is the cut-off point for the financial year, but obviously things never stop and we'll keep going through into the rest of 2018.
Yeah, and so let's hope that FY19 is just as positive, we sort of said, on that total return on capital basis, but as we alluded to, there may be some headwinds to come.
Thanks very much, Evan.
Thanks, Tony.
Thanks for joining us.